What's going on? Alex here, and today I'd like to welcome you to the first ever Efros Financial Power Hour. Now, the idea is that this is going to be a live stream that we do on a weekly basis on Wednesdays at 7 p.m. Pacific time and 10 p.m. Eastern time. And the idea is that we hang out, get together, discuss finance, accounting, taxes, careers, the CPA credentials, CFPEA, whatever else you guys want. You ask questions, I'm going to do my best to answer them. And the focus is on this being a live format. So we want to do this in real time. Let's get some good questions happening. Invite your friends, get some tea happening. I know I have mine right here. And with that, I am good to go. Now, I have some questions prepared here that I found on Reddit regarding taxes and all of that good stuff. But the idea is really for you guys to ask questions, and possibly in the near future, there'll be the ability to actually call in and ask questions that way. That should be a lot more interactive, and we'll see how that all works out. Maybe I just leaked a secret about what this is going to turn into in the future, but you're here at the very beginning, so you deserve it, and I appreciate you. The idea, though, get your questions up in the chat, and then we'll take it from there. And Andrew, welcome to the live stream. I see you right there. So let's rock and roll with the first questions. Again, as we're going through, feel free to drop your questions in the chat. I'm going to go back and forth between Reddit questions and your questions, and we're going to fill this hour up pretty quickly. All right, with that, let's turn our attention to the first Reddit question of the day. And that is from Intellectual Raptor, and it goes as follows. Tax burden split for non-partner work in a partnership LLC. I'm a partner in a two-partner LLC based in New Jersey. We are a video production company with 50-50 ownership. I'm invoicing some freelance work through the LLC that my partner has nothing to do with. Can I, as an individual, invoice our LLC for the full amount so my partner can avoid taking on the tax burden and including it as income for himself? If it's helpful, this is the only work that's been billed through our LLC for 2022. To date, I've been keeping enough money in the account after paying myself for us both to cover end-of-year tax implications from my personal work. Thanks, and sorry for the stupid question. Well, first thing I want to say is there are no stupid questions. I would venture to say that the only stupid question is the one you don't ask. All right? And being that my practice works with startups and entrepreneurs and people that are in business for the first time in their lives, we see this more often than we would like. And the issue in this situation is that there's a two-member LLC that was formed. And you have one of the partners doing freelance work through the LLC that the other partner has nothing to do with. What is the issue here? The issue is that it sounds like the LLC is being run in what we call in technical terms a willy-nilly fashion, meaning this entity was created and then one partner is using it for one purpose, another partner is not using it at all. And that leads us to yet another issue, is that it sounds like there's no partnership agreement in place with this LLC, right? So you have two partners, and the LLC partnership operating agreement, or whatever you want to call it, will govern how that LLC functions. And typically within a partnership agreement, you'll have the layout of income allocation, loss allocation, and all those different facets that govern the relationship between the LLC and the partners. And when you have the operating agreement, it's typically pretty clear how the income flows, how the losses flow, how all of that is shared. It's not necessarily that it's a 50-50 partnership from an ownership perspective that the income and losses flow 50-50 as well. That's not necessarily the case. So the operating agreement can specify how this relationship works with a high degree of specificity. The more specificity, the better, because when you have situations like this, when there's income in the partnership that's coming in, you'll know how that's to be allocated amongst the partners. In this situation, just from how this is worded, I get the feeling that there is no partnership agreement, operating agreement, LLC agreement, whatever you want to call it. So these partners are treating this LLC as just a fancy name that they could put out there saying, oh, well, I'm not Alex Efros, I'm Alex Efros and Partners LLC, and let me bill my clients through that entity and make money that way. The problem is that that LLC has its own employer identification number, meaning EIN, right? And if you are a partner in a two-partner LLC, then you've probably applied for that EIN and specified to the IRS that this is a partnership, which means that on your EIN letter that you receive from the IRS is saying that, hey, we expect a partnership tax return to be filed by this LLC by whatever the deadline happens to be. Usually, if it's a calendar year entity, talking about March 15th after the end of the current year, okay? And the first issue that can arise here is that if you're treating this LLC just as a conduit to do work on your own, not involving your partner at all, that can result in you absolutely forgetting to file the partnership return. Now we have a delinquent partnership return with two partners, and the penalties and interest add up on a monthly basis for every month that that return is late. And often in situations like this, we see that the partners don't really have a robust understanding of what is actually necessary for a partnership to exist from a tax perspective. And one of those requirements is that they have to file annual tax returns, with few exceptions. So that being the case, here, if you were to have the income flowing into the LLC, the next question is, how is that income supposed to be allocated? Now, when there's a partnership agreement in place, it should be fairly straightforward. If there is no partnership agreement in place, then it gets a little bit more difficult in terms of allocating that income. So once, let's say, $100,000 hits the account, then if it's a 50-50 partnership, the default treatment is that 50% of that income flows to partner A, 50% flows to partner B. Now, in this situation, you'll have 100,000 coming in, and it looks like the full 100,000, let's say, will flow to partner A, and nothing will flow to partner B. The issue there is that this area is rife with abuse, okay? You'll have partnerships where multiple individuals are in business together, and when it comes to actually allocating the income and losses, they'll look at the tax rates of each partner. Okay, we know this happens. We are on the front lines. Come on. So they'll say, hey, partner A doesn't have a lot of income. His tax rate's pretty low, whereas partner B has a lot of other income outside of the partnership, and his tax rate's really high. So what we're going to do is, and this is not the correct way to do this, but I'm just saying what happens out there because this is real life. That partnership will allocate all of the income on the Schedule K1 to partner A so that partner A gets the income. They pay some tax, but not as much as partner B would have paid if that income was allocated properly. So then partner A will typically transfer the amount due to partner B from one bank account to the other, and partner B might even reimburse partner A for some of those tax implications that partner A incurred. That's not the correct way to do it, all right? And if the IRS gets wind of this, especially the states, if they get wind of this, you're gonna have big problems, all right? Muchos problemos, all right? I'm not known for my Spanish, but I tried. With that, this is what I'm seeing here, okay? And the fact that you're having income coming in and you're allocating it all willy-nilly opens up the possibility that the IRS will look at that and say, wait a minute, you are 50-50 owners, and based on that, we're allocating a 50-50. Then the burden of proof is on you to make the case that that's not applicable, all right? That's not a battle you want to fight because now you have two people involved. One is trying to make the case that the other is not involved, and in a partnership, it's like a marriage. Sometimes they start off real good, but they don't end up that way, all right? And all too often, we'll have a partnership dissolve just because the partners don't get along, and that makes fixing the tax implications of doing it incorrectly from the beginning that much harder to fix. So another point of view may be that the income comes into the partnership, let's say $100,000, and let's ignore the expenses for a second. So the $100,000 then flows all to partner A, okay? with 0 flowing through on the K1 to partner B. That would typically be classified as a guaranteed payment in partnership terms, right? So when you have a set amount of income going to one partner for work, that's known as a guaranteed payment. And even though it wouldn't necessarily be correct, some partnerships will say, hey, let's just handle it that way. What's the downside? Well, the downside is that by receiving a guaranteed payment, you just negated your ability to take advantage of the qualified business income deduction, QBI. What am I talking about? This is from the Tax Cuts and Jobs Act, all right? This came out fairly recently, but if you look at the IRS frequently asked questions regarding the QBI deduction, you'll see what is qualified business income. And you'll see that items such as capital gains and losses, certain dividends and interest are excluded. W-2 income, amounts received as reasonable account from an S Corp. And this is where we need to take note. Amounts received as guaranteed payments from a partnership. All right. So what you've done is taken partnership pass-through income that otherwise may very well have qualified for a QBI deduction, which could be worth 20% in terms of the reduction in income that you would receive. Now you've negated that altogether by taking the position that this was indeed a guaranteed payment, which I'm not saying is correct, but if you're going to go down the rabbit hole of just doing it all willy-nilly, that's yet another roadblock that you have in your way in terms of how this is all going to play out. So that $100,000 will flow through, no QBI deduction if you classify it as a guaranteed payment. And all too often, we see entrepreneurs do it wrong up front, then try to sweep it all under the rug. And it doesn't play out very well because the tax code is written with some fairly rigid rules in place. And when you do it wrong from the onset, it's typically not very easy to go back and fix it later. All right. So in terms of the question here, if you're doing some freelance work through the LLC, first of all, cut it out. All right. That LLC is a partnership. So if there's another partner involved and they have nothing to do with the partnership, the first thing you need to evaluate is whether this entity makes sense the way it is or whether you need to restructure it, potentially without the other partner, because if they're not doing anything, they should have no involvement typically with that entity, right? If you want to form a single member LLC and shut this one down, that's yet another question, right? So you form your own LLC, you can invoice through that all you want, and all of the income will flow through your Schedule C unless you make the S Corp election, and everything will be pretty straightforward. But if you elect to have another partner involved, again, it's like a marriage. You can't just ignore your spouse all of a sudden, and that's what's happening here. I would not advise this proposed setup at all. We need to go back to basics and first ask if there is a partnership agreement. If so, what does it state? If there is no partnership agreement, we need to make sure that this allocation makes sense when you think of both the partnership and its partners. Because if I'm an auditor, what I'm looking for is income coming into the partnership and then flowing through to one of the partners, not the other. And if that partner that receives the income has a low tax rate, especially if it's lower than partner B, let's say, then I'm going to be fairly suspicious. I'm going to look into that really closely. Again, you don't want this mess. It's going to create more headaches than anything. With this whole situation, I would say hit the brakes, restructure it if you need to, and then go forward doing it the right way. All right. So hopefully, Intellectual Raptor, that helps clear some things up with regard to how to treat this particular situation. All right. I see you guys have a lot of questions coming in. I love it. Thank you so much. I'm going to get through this next question and then take a look at how much of that I can answer here, because I did prepare some good stuff for you guys, right? As always. This next question comes from Reddit as well. And the subject is 401k contributions from my own LLC. So LLCs fairly popular today. This is from annual ad 8272, and it goes as follows. Just pondering some tax optimization strategies. If I owned an LLC of which I was a sole employee, okay, we got to be careful with the terminology, all right, because you're not an employee of your own LLC. You shouldn't issue yourself a W-2 or anything like that. So you would be a self-employed individual. You would be a member of the LLC, but you wouldn't technically, from a tax perspective, be an employee. Can I contribute the maximum allowable amount, $61,000, into my 401k as an annual profit sharing benefit from the LLC to myself? And would that be a deduction for the LLC and non-taxable for me? Is there a better corporate structure for that than an LLC? All right. And if you guys have an opinion on this, shoot it down in the comments. But there are a few things that stand out about this question. Firstly, the $61,000. Where did this person get this number? Well, if you look at the IRS website, it says the IRS announces 401k limit increases. And you'll see on this site that it mentions Notice 2021-61. If we open up that notice, you'll see all of the various updates to what you can contribute to retirement plans, and you'll see that the limitation for defined contribution plans under section, don't worry about that, basically 401k plans, is increased in 2022 from $58,000 to $61,000. All right? So those are two limitations, $58,000 for 2021 and $61,000 for 2022. So that's what this person is asking about. They're saying, hey, can I just load in that 61 grand straight into the retirement account? What do you guys think? You guys that are watching, yes or no? Or is the answer a common answer that us tax professionals give? And that is, it depends. Let's take a look at some scenarios. I pulled up the tax software for you guys, and essentially we have a fairly straightforward situation. We're using the 2021 tax software because the 2022 is not available yet. And you'll see that this is a Form 1040 for a self-employed individual. Nothing much going on the return, except for the fact that on Schedule C, which is if you're working as a single member LLC, this is where you'll report your income and deductions. Okay, so there's no separate federal LLC tax return. It all goes to your Schedule C. All right, and this is $100,000 of income, right? We didn't make it too high. We didn't make it too low. $100,000. And let's see how that plays out. So if we take a look at the 1040 itself, you'll see that the $100,000 is coming in from Schedule 1. What is Schedule 1 all about? It's just showing you the number from Schedule C. That's all. We have no expenses, just $100 grand. So then it flows to the front of the 1040. You do get the deduction for 1/2 of self-employment taxes, because when you're self-employed, you're both the employee and the employer. Again, not that you W-2 yourself, but I'm just trying to explain where this $7,065 amount comes from. All right, so if you go to Schedule SE, you'll see all those calculations playing out. And right here, you'll see $7,065. So there are no questions about that amount. It's simply the deduction for 1/2 of self-employment tax, which in this case, it comes from line 12 of Schedule SE, and that amount is $14,129. Okay? As we go through the 1040, you'll see we have adjusted gross income. We're taking the standard deduction here. Again, we want to keep it simple. And from there, we got the qualified business income deduction. So we're assuming that the Schedule C business is a qualified trade or business for purposes of QBI, or qualified business income. And from there, we see that there's not much else going on. And what we want to focus on is this total tax line on line 24. The baseline scenario is telling us that the total tax is going to be $24,029 at the federal level. We're not including states. We want to keep it simple. And we're going to record all of these amounts on a handy dandy spreadsheet. You guys know me. We always do spreadsheets around here. Now let's take a look. In terms of the retirement plan, we're assuming none for the moment. Then there's no contribution amount for the employee. There's no contribution amount for the employer. Again, when you're self-employed, you're both. And the contribution total is still zero. Total federal tax comes out to $24,029. I'm just going to take the amounts from line 24 and record them here. All right. And in the difference column, you'll see how each retirement plan contribution changes the federal tax from this baseline scenario. All right. Now, what if this business owner said, hey, I want to contribute to a traditional IRA, right? In 2021, the limitation was $6,000. So we're going to assume that this entrepreneur contributed the maximum. So we're going to go in the tax software and say, hey, give us the maximum deduction for the IRA contribution, would you? And what does that do to our tax situation? Again, we're looking at the 1040. We want to see the changes. And you'll see that on Schedule 1, there's something different now. So we have the deductible part of self-employment tax. It's important to know that the retirement plan contribution is not reducing your self-employment tax. It's reducing your taxable income, but it's not reducing your self-employment tax. Common misconception. Now, the software does its calculation and it determines that the taxpayer can contribute the maximum for the year, which is $6,000. All right, no other retirement plan contributions happening. And you'll see that all of this goodness adds up to $13,065 in terms of the adjustments to income. And that number will look familiar because you'll see it again on the front of the 1040 right here. Okay. And from there, we look at the total tax amount. You'll see that it's a bit lower. So now the total tax amount changed to $22,973. All right. So let's record the traditional IRA contribution and how it changed things. We have $6,000 in terms of the employee contribution. Technically, you're making it on the personal level. It's not really related to the business per se, but we're going to call it employee for now. It's definitely not an employer contribution. All right. And these areas marked in red just indicate to me that they're zero, so I don't screw this up on the live stream. All right. Total contribution is $6,000. Total federal tax is $22,973. And the difference is $1,056. And you might be saying, hey, wait a minute. That's not that much. We contributed $6,000, but we're only saving $1,056. Well, a few things to note. One is that the traditional IRA contribution, as we saw here, does not reduce your self-employment tax. Because if we go back to Schedule SE, this self-employment tax amount on line 12, 14,129, has not changed. All right? Neither has the deduction for 1/2 of self-employment tax, which is a $7,065 amount. All right. What has changed is that your taxable income is going to decrease by $6,000, which is taxed at your marginal tax rates. And the fact that the taxable income is brought down to $59,508, that's not a tremendous amount in terms of what tax bracket you're going to be in. So you're not in the higher tax bracket. So the bang for your buck is going to be lower in terms of the tax savings as compared to the deduction for the traditional IRA contribution. Now, let's talk about the self-employed pension plan, or a SEP plan. Now, the self-employed pension part is not a great description of what this plan is all about. It's not really a pension plan. It's essentially an IRA that the employer sets up, or you in this case if you're self-employed, and you can make employer profit sharing contributions to it. So unlike a 401k, there's no ability for the entrepreneur, the business owner, to say, oh, I want to have a salary deferral of $19,500 or $20,500. That doesn't exist with a SEP. But at the employer level, you do have the ability to make retirement plan contributions. Now, let's see what that would look like. Going back to the tax software, we're going to take out the traditional IRA contribution for now, going back to pretty much base scenario, and you'll see that we will enable a SEP contribution. All right, so self-employed pension plan, we're going to say, go for the maximum. Now, looking at the tax return, let's see what's changed. We still have the $100,000 in income from Schedule 1. Let's take a look at Schedule 1. Aha. So here we have the $7,065, which we're already familiar with. You're experts by now. But now you have a deduction on line 16 that is labeled self-employed SEP, simple and qualified plans. And there's a good old-fashioned worksheet here that you can check out. If you're having trouble falling asleep, this will knock you right out. Promise. This worksheet is from publication 560. So if you Google IRS publication 560, you can find this worksheet and you can figure out what the total amount is that you can contribute to a particular retirement plan, in this case, a SEP. Okay? But that's where the $18,587 comes from. That's the employer contribution to a SEP plan. Now, self-employed people, they're both the employee and employer, keep in mind. So let's record our contribution here. All right, so no employee contribution for the SEP plan, but on the employer level, we have $18,587 587. Okay? That gives us the total. And let's look at the federal tax amount. What do you guys think? Did it go up or did it go down as compared to the traditional IRA? Well, in this case, it's $20,751 on line 24. So $20,751, bam. The difference as compared to this tax amount, all right? So we're always comparing to baseline in this difference column, which means no retirement plan contributions, is $3,278. Now, that's more than a traditional IRA contribution, but again, you might be saying, well, that's not that much. I would think that the difference would be bigger because we're contributing $18,587. Again, as your tax rate increases, if you're in a higher marginal rate, then these differences are going to be more substantial. Right now, they're on the lower side because the income isn't subject to the higher tax brackets. Makes sense. All right, so that's the SEP plan, another option for business owners to make contributions to retirement plans and get a deduction in the current tax year. Let's look at yet another option. And before we do that, I also want to discuss, well, let's get to this in a second. I was going to compare the SEP plan and the 401k, but I want you to see the numbers first, and then we're going to compare why a business owner would go for the SEP over the 401k. This is an important reason. With the 401k plan, things work out a little differently because those of you who have W-2 employment may be familiar with this. There are both the employer contributions and employee contributions. The employer contributions are known as profit sharing contributions. So we're going to enable those. We're going to go for the maximum. And on the employee side, there are elective deferrals. So when you hear employees saying, oh, I contributed $19,500 to my 401k or $20,500 to my 401k, depending on the tax year, they're referring to the elective salary deferrals. That's the employee portion. Now, the employer portion is the profit sharing portion. What we're doing here is maxing out both. Make sense? Okay. Let's go back to the tax software and see how things have changed. If we go to good old Schedule 1, we can see that the self-employment tax, again, does not change. Neither does the deductible part of self-employment tax, $7,065. But what we see here is the self-employed SEP simple and qualified plans line has changed to $38,087. Whoa. Again, this worksheet is from publication 560, and you can work through it, but you'll see here that the $19,500 amount is represented here as the elective deferrals, and everything remaining is essentially the profit sharing portion. So let's jot this down. Alrighty, so we have $19,500 in terms of the employee contribution. This is in 2021. These numbers change annually. And in terms of the employer portion, what we're going to do is just take 38,087 and subtract the 19,500, and that gives us the employer contribution. And both of those are combined to give us the deductible amount on line 16. With that, let's just check. We have 38,087. Beautiful. Let's look at the federal tax amount. Now, line 24 is showing 17,989. All right. Okay. Now we're saving a few bucks, right? I mean, we're contributing 38,000, but you are reducing your federal tax by $6,040. Let's not forget that there's also state implications as well. So if you live in a state, you work in a state in which there's an income tax, then that would add to the tax savings. We're just looking at federal purposes for now. So you might be looking at this and you might be saying, wait a minute, you can contribute a lot more to a solo 401k than you can to a SEP. So why would any business owner in their right mind choose to have a SEP plan over a 401k plan? Well, often we get questions from our business owner clients fairly late in the game. And they might call us on February 1st and say, hey, by the way, for that last tax year, I want to contribute to a 401k. Is everything cool? No, because the 401k needs to be established before December 31st of the tax year in which you want to make contributions to that plan. And if it's February of the next year, then the solo 401k is a no-go. All right? unlike a SEP plan that you can establish after the year end. So if a tax client calls us in the middle of busy season, which they love to do, and they'll say, hey, I want to make a 401k contribution for last year. I haven't established a plan yet. Is that okay? We say, that's not okay. You can establish a 401k plan for this upcoming year, but for the last year, if you want to establish a SEP, you typically have until the tax filing deadline to do so. And that is an option to make retirement plan contributions, not as much, but something, for that year that already closed, for which the December 31st deadline has already passed. Okay? Now, let's just make sure I didn't screw anything up so that we are looking good. All right. Then the question is, and all of you tax experts out there, chime in if you would. What other options are available to help this entrepreneur out? Because again, self-employed individual with an LLC wants to contribute $61,000. Well, we see here that they can't, because the maximum contribution amount they're going to get if they don't go into defined benefit plan territory, that's a whole different beast. But in terms of the defined contribution plans, $38,087 seems to be the limit based on the income. That limitation comes into play because of the amount of income that comes out of the business. Because if we were to ramp up this $100,000 to a bigger number, so let's just shoot for $300,000. Okay, I just want to show you guys the difference. All right, so if we go to $300,000 and look at the maximum contribution amount on Schedule 1, then we see it's $58,000. Again, remember that for 2021, the limit was $58,000. For 2022, it's $61,000. So if you have substantial enough self-employment net income, then you may be able to contribute up to that maximum amount to your 401k plan. Important to keep in mind, but it's governed by the amount of net self-employment income. How do you figure all this out? Well, you pull out that good old-fashioned worksheet from publication 560, and that will take you to the holy grail of figuring out how much you can actually contribute. And you typically have until the tax filing deadline to make that contribution. So if you're self-employed, you're looking at April 15th. You'd want to get that all contributed in order to get the deduction for that year. All right, so that is a bit of insight into how this all can play out. But let's go back to the spreadsheet. Are there any other options, or did I cover them all? You're self-employed, you're making a killing, building an empire. Do you have to choose just one of these options? No, not necessarily. Now, we were looking at the scenario where you have, let's change the income back to 100,000 just so everything looks familiar. All right, and we have the situation where we contributed to the profit sharing 401k portion at the maximum and the elective deferrals to the maximum. What if we also throw in a traditional IRA contribution on top of that? Is that illegal? Can we do that? Are we going to get arrested? Let's see. All right. Looking at the tax return here, you'll see that it is indeed possible to make contributions to both the 401k plan, employer and employee portion, and also get the traditional IRA deduction going on. All right. So very powerful in terms of the potential to reduce your amount of tax in the current year. And you can see here that the total tax goes even lower to $17,413, whereas it was $17,989. All right. So different things to consider. And the fact that you can mix and match these plans is both a great avenue for saving taxes, but it also leaves a huge amount of screw-ups that clients can get themselves into. And that is why we're here to help, right? So we can estimate what the income is going to be from the business and then figure out the most optimal way in terms of making these contributions to achieve that client's goals. All right. And it may not always be obvious how you can allocate these things. And sometimes after the year is over, our options become more limited. So that's why it's crucial to get the planning done earlier rather than later, because you can potentially miss out on a huge amount of deductions and possible tax savings if you choose to wait and defer this to the last minute. All right. So that's a little bit about retirement plan contributions. there's a lot of flexibility, but there are also many ways that this could go wrong. You don't want to end up on the wrong side of retirement plan contributions, because at the very extreme end, it may disqualify your retirement plan altogether. So there's nothing better than having a client get their 401k disqualified, which results in a $3.5 million tax event, which is always a surprise. Not a good situation to be in for the client or the tax professional. So planning is king. All right. And the last question here is there a better corporate structure for that than an LLC? Well, now you're getting into an area where you really need to ask more questions to understand what the goals of this client are. Because if they're just looking to maximize retirement plan contributions, that's one thing. But there are also other implications, pros and cons for you to keep in mind before you consider changing the structure of a particular business, especially from a tax perspective. If this person is making 100 grand, S corporation election may not make all that much sense. But if they're making 800 grand or really anything above 150,000 as the net before the owner pays themselves, it's time to start thinking about the S corp election, which may optimize the tax situation even further. All right. If you're still sticking around, like the video, subscribe to the channel if you haven't already. I know a lot of you aren't subscribed. And let your friends know that 7 o'clock Wednesdays, 10 o'clock Eastern, we're hanging out. We're doing this live. We're answering questions. Life is good. And I see you guys' questions there. We're going to get to it as soon as I address this next Reddit question. I promise. All right. This question comes from Jesselwin1 and goes as follows. Is providing care in exchange for money for a relative considered a gift or taxable income? My stepdad is caring for his great aunt. It's a beautiful thing. He is anticipating $90,000 annually. An even more beautiful thing. In most situations, would this be a gift or taxable income, and why? All right, those of you watching might be jumping out of your seats, but we still need to analyze this from an income tax perspective. What we have to contend with in this regard is good old Internal Revenue Code Section 61, one of my favorites. I sometimes, when I'm feeling lonely in the middle of the night, I pull up Code Section 61 and I read it out loud. No, I don't. Maybe I do. And what that says in very simple terms is that gross income means all income from whatever source derived, including but not limited to the following items. And the first shebang is compensation for services, among other things. Now, that's what we run into in this case. Now, if you have a code section that says something's not taxable, then you can make the case that it's not taxable. But by default, this would unfortunately be taxable. I had a client come to me a little while back, and we were doing this person's tax returns. And it came to light that this person's parents were living in a house that she owned. Okay? And they were paying amounts on a monthly basis for the use of that property. As soon as I heard that, I said, okay, well, you're getting rental income. That's going to be taxable income. Let's figure out your expenses and go from there. And this person pushed back and said, wait a minute. I heard that the first $15,000 of income can be a gift. And then anything above that would be potentially taxable. The issue with that is that the first $15,000 of anything can't just be construed as a gift, all right? It has to qualify as a gift, meaning that the person giving it has a completely disinterested motivation in that they're getting nothing in return. All right. You can't give a gift and then expect labor out of somebody. You can't give a gift and expect a return from somebody. You can't give a gift and expect for it to be paid back. So it has to be a completely disinterested generosity that is influencing that transfer of funds. And right in the description here, it's apparent that the $90,000 is going to be received for services provided to the great aunt. So with that, the prospect of a gift unfortunately goes out the window, because when you're exchanging services for funds, the tax code looks at that as income. And now the question really becomes, would this stepdad be an employee of the great aunt, or is this person going to be a self-employed individual? Now, that depends on the facts and circumstances. Kieran, I see your comment here. Very nice. That would determine how this plays out. So we'd want to know the whole story. We'd say, hey, do you provide care just for this one great aunt, or is this something you're doing for 18 different people and this is how you make a living? It's possible. I've heard crazy things. You'd be surprised. That's the first question. Then you'd have to assess how much control there is. Now, again, we don't get into employment law here, but the issue of employee versus contractor comes into play, and that would affect the tax implications and the filings and all of that. That's why, again, planning is king. You want to approach this up front instead of after the fact with 90 grand in the account thinking, oh my God, what do I need to do for taxes? All right. So in this situation, unfortunately, there isn't too much flexibility unless this is an IHSS situation. Now, in-home supportive services, this is definitely a California thing, but it may be also applicable in other states. So if your care and the circumstances fall under these limited set of conditions, then potentially you may be able to exclude the income from taxes at the federal and or state levels. This is a very limited exemption, but I wanted to throw that out there. It's not applicable in a majority of cases that I've come across, but I did want to throw out that if it's IHSS or in-home supportive services in play, it may play out differently from a tax perspective, okay? Just to give you guys the real deal. All right. Those were the 3 questions that we got from Reddit for today. Now, I see you guys have been very active over here, and let's take a look at a question from Not Ben 101. Now, my question is, if you're not Ben, who are you? All righty. Now, let's get this question up on the screen here. All right. And this person asks, do you imagine student loan forgiveness will be taxable? So this is referring to the new student loan forgiveness provision that's been put out there by the Biden administration. They're basically canceling $10,000 of student loans. This is very new. I'm not an expert in it by any means, but it was covered in the news. This is a Fortune article about it. And typically, when there's a forgiveness of debt, again, this is not in all situations, but it is taxable under the tax code. Okay, you could look to Section 108 for that. But there are exceptions, one of them being public student loan forgiveness and other such provisions. So when the PPP loans came out and were forgiven, the first inclination was that that would be taxable. But then Congress said, hey, wait a minute, we need to make that non-taxable because we don't want to give a benefit and then take some of it back immediately. That doesn't look good politically. So typically, when there's a federal provision offering some kind of grant or forgiveness of debt, in many cases, they will make sure that there's not a detrimental tax effect and that it's not taxable. All right? So in this case, the act that came out a little while back, it's ARP. Now, I want to make sure that we find the full name. The American Rescue Plan of 2021 had a provision where the recipients of student loan forgiveness will not have the amount of forgiven taxed until the end of 2025. All right. This is fairly new. I would want to confirm that this is indeed applicable. This is just coming out within the last few days. But it's important to note that the states may not comply with the non-taxability, and it may be taxable at the state level. The word I want to use was conform. The states may not conform. California loves not to conform to federal tax provisions. So you may end up in a situation where the forgiveness is taxable at the state level, whereas they're not taxable at the federal level. All right? So you need to verify with your individual state whether or not they conform to this provision to avoid inadvertently understating your income for the year of forgiveness. All right? Good question, Not Ben. Hopefully that helps. All right, let's look at some of the other questions. Keep them coming, guys. I appreciate it. All right, let's look at this question right here from our friend Andrew. All righty, let's take a look at this bad boy. And before I answer this question, I'm going to take a little hit of my tea while I take a quick 2-second break. Like the video, subscribe to the channel, drop a comment below, would you? Love you guys. All right, back in action. The question from Andrew goes as follows. What are your thoughts on investing in low-cost index funds, which is Jack Bogle's strategy, versus picking single stocks? Well, it really depends, and I have some background on the investment side. I used to work at a firm that managed assets right around $300 million for individuals mostly, and it was always a question of return appetite versus amount of risk that the client is willing to take on. All right? So it was return appetite and risk tolerance. Those were the two main parameters that you take a look at to determine what strategy works for who, right? Because when you're on the investment side, and this is not investment advice, none of what I say today is investment advice. If you're on the investment side, you're typically having to assess how much someone's looking to make from their investment versus how much they can stand losing. If a client has a desire for risk, but they don't have the capacity for risk, that could create a problem. What do I mean? Well, sometimes clients came to us, new clients, and they said, hey, here's my last $300,000 that I have in my retirement account. Invest it super aggressively. We can't do that, all right? Because that client does not have the capacity to take risk, in our opinion, versus the desire to take risks. So they want to take the risk, they want to shoot for the stars, but we're not going to let them hang themselves by going to Vegas with their last $300,000 and putting it all on black. That's not what we do. As a fiduciary, you have to know when to say no to your clients, and that's one of those situations. Same plays into answering a question like this. And all I know about you, Andrew, is that it doesn't look like you're subscribed to the channel, which if that's the case, please feel free. But aside from that, I really don't know anything about what your goals are and how much risk you're willing to take and capable of taking. Those are the main questions. How do you assess that? Well, we usually said to clients, if you're dealing with full-on equity exposure, which means you're 100% stocks, you're in for that roller coaster ride, baby. So if the stock market drops 20%, you have to be okay with your portfolio dropping very close to 20% because you're all equities. If the market goes up 20%, you're going to enjoy most, if not all, of that upside. But again, you're signing up for the roller coaster. On the other hand, if you have a client that says, look, I can't stand to lose a single penny. And if I lose $10 in my investment account, I get nervous. I lose sleep. That client should probably not be in equities. They should be in bonds, in fixed income, right? Things that are not very volatile. You're not signing up for the roller coaster. You just want to sleep and rest easy knowing that if the market does this, your portfolio might do a little bit of this, but you'll still be whole and you won't lose your shirt out there in the market. Going back to this question, index funds that are low cost are a beautiful thing. Now, before you used to have mutual funds, which had high expense ratios, and they were more difficult to get in and out of because you can only buy them or sell them once a day. Now you have ETFs that cost almost nothing in terms of the management fee. And it's almost a no-brainer to your average person who doesn't want to get involved in analyzing financial statements and listening to the investor calls and dealing with that on a day-to-day basis. That's a full-time job in and of itself. So you might not have the ability to even monitor individual stocks because at the investment firm that we worked on, we had a few strategies that had 50 or 60 equities that you had to spend all day researching because at any point, a piece of news could come out and that's it. Your portfolio craters and you have some angry investors on the phone. I feel like the low-cost investment funds, the ETFs that are out there are a beautiful thing, but they're not for everybody, right? Someone looking for a higher return than the market offers is not going to enjoy their returns after we put their funds into low-cost index ETFs, all right? They're just not going to be thrilled. If they want venture capital returns or if they want private equity returns, this is going to be very disappointing. But for those clients that say, look, I don't want to deal with it. I want to let it ride. I don't want too much risk. The low-cost index funds may be a great option. If you're picking single stocks, you better know what you're doing. You better have the desire to lose and the capacity to lose. Because if you want to diversify, then you're picking a whole bunch of single stocks, right? Which starts to look more and more as you increase the number of equities like an index fund anyhow, right? Okay, so hopefully that answers the question for Andrew. Keep them coming, guys. We're going to be here for a little bit longer. All right, so this question comes from Andrew. Again, we've got a lot of Andrews on the call today. And Andrew asks the following. I got my EA, which is the Enrolled Agent Credential, earlier this year. And I'm currently in the process of finishing applications for several MBA programs. Have you found your MBA to be useful in your career? In my particular case, my only exposure to accounting in my undergrad was 2 classes. And in my last year of college, I realized that I didn't have enough credits to graduate on time. Back there at the College of Staten Island, very prestigious institution. With that, I said, no, I'm definitely graduating on time. So I loaded up my schedule with a whole bunch of credits. I believe it was 21 credits or something like that, because I was determined to finish college in 4 years. I didn't want to be in the 5-year program. One of those classes that I used to build my schedule just happened to be an accounting course. Not that I was interested in it, not that I liked it or enjoyed it. I knew nothing about it. I was a psychology major looking to get my PhD in psychology. But I had a gap in my schedule. It wasn't too early in the day, so I said, let's throw an accounting course in there. And that course ended up changing my life. You will see more of the description of all of that in the video I have that describes why I became a CPA on this channel. So take a look at that. But I took an accounting class the first semester of my last year of college, and then the last semester of my last year of college. That was my only exposure to it. I did well in those classes, but I knew nothing in terms of analyzing financial statements and looking at publicly traded companies, things like that. That was where my MBA program came in. I went to the Rutgers Public Accounting MBA program. They refer to it as PAMBA, right? So PAMBA. And it was incredible. It was amazing. It was an accelerated program. So it was a 2-year MBA in about 13 months. And if I remember correctly, 3 of those months were left for an internship. So you basically had 9 months of classes and then about 2-3 months of internship, and then you finished up the courses from there. I believe that was the layout. What that allowed me to do is get real-world experience while getting an understanding of accounting and analyzing financial statements and understanding corporate mergers and consolidations, all this good stuff. So for me, if I didn't have the MBA program, I would be dead in the water. I would have no idea of how any of this works. Aside from that, that MBA program was tailored specifically to hit all the various courses you need to take the CPA exam. So I already had the coursework ready to go as soon as I graduated to start knocking out those CPA exam sections, a lot of which I did before starting to work at PwC. Very important, because when you start working, the CPA exam is brutal. That's my perspective on it. Without the MBA, I don't know where I'd be right now, just to sum it up. But if you're evaluating it from your perspective, you really have to ask yourself, okay, how much do I love this topic that I'm going to learn in this MBA program? What is going to be the return on investment? Because student loans can be a scary beast, especially since you can't discharge them in bankruptcy in many cases. So you're really making a huge commitment to pay these amounts back. And even if you're on an income-based, income contingent repayment plan, when those loans are forgiven after 20, 25 years, it can still be taxable, as we touched on a bit earlier. So you have to make that analysis based on your situation and really assess whether the debt you're taking on is worth it for the degree you're getting. One metric that's thrown out there is, will your beginning salary that you have when you leave your MBA program equal or be more than the amount of debt you took on? So as an example, if your MBA program costs you 60 grand, and when you leave that MBA program, you're expected to get a job that pays you 60 grand, you're right around at that break-even point. That's not bad. because you could pay that off. That was actually my exact situation. And you could pay the debt off in a few years and it's not going to be that much trouble. But if you're looking at a $250,000 program or something along those lines, if you consider your undergrad debt as well, you really have to ask yourself, is this a smart move? Especially given today's climate where you can learn basically anything with a quick Google or YouTube search. I mean, the amount of information out there is incredible. So make your own analysis. In my perspective, the MBA program was absolutely crucial to my development, to getting me to where I am, but results may vary. All right, that's what I'll say there. All right, so let's look at this next question from Claire. All right, we got a little bit more time here. This will probably be the last question for today. But again, guys, subscribe to the channel. Hit that like button to let me know that you guys are into this. And we're going to keep growing it. All right. As long as you guys participate, hang out, we'll be all good to go. All right. If I did not file Form 8606 for an after-tax IRA contribution in the last 10 years, how do I fix it? Doing an amended return is only available for the last 3 years. Thanks for your opinion. No, Claire, thank you for your question. I love these sorts of questions. Very often we'll have clients confess to us. They'll say, Alex, I have sinned. And they'll tell us that for the last few years, I haven't done this, I haven't done that. I know I should have done it. How do I fix it? And sometimes the solution is that it's kind of painful. You have to go back, file amended returns, this, that. It becomes a mess and it's expensive from our perspective, just in terms of the fees that we're going to charge this client. In this case, it's a bit better than that because it's an after-tax IRA contribution. Now, what does that mean? A before-tax IRA contribution results in a deduction, right? Which affects the total amount of tax that you're paying in a particular year. Whereas an after-tax contribution does not result in a deduction in the year of the contribution. So the total tax should not change based on this contribution. And Form 8606, just so everyone's aware, is the form where you report non-deductible IRA contributions. All right, so let's pull up good old Form 8606 so we can take a look. All righty, so here is this wonderful, beautiful tax form. And how do we fix this issue? Well, you'll see here that has non-deductible contributions to traditional IRAs, which is what we're talking about here. And if you take a look at the very bottom, you'll see that it says sign here only if you're filing this form by itself and not with your tax return. What that means is that even if you didn't file Form 8606 for the last 10 tax years, you have the ability to file Form 8606 for each one of those years without having to amend your tax returns. It's a beautiful thing. Now, watch out at the state level. There might be additional filings there, but at the federal level, this is a way to establish basis in your IRA based on the non-deductible contributions. Now, you'll have to file Form 8606 for each tax year. You don't file the 2021 form 10 times, all right? But the benefit is that you'll be able to fix this all, get it all filed, send it certified mail with return receipt. Tracking is crucial, especially the way the IRS is broken now. They're super behind, and a lot of these filings are probably ending up in the trash. So you want proof that you sent this in. And also on your tax return, typically you're able to track the basis in non-deductible IRA contribution. So we're not going to get too in-depth on that right now. We've just hit the hour. So unfortunately, that's a wrap for us today. Let me know, guys, in the comments. Is this helpful? Did you enjoy this? What else can I do or not do to make this better for you guys? Would you guys like the ability to call in and ask questions that way? What am I missing? What should I be doing? What shouldn't I be doing? I welcome your feedback, good or otherwise. And we'll be back a week from now, 7 p.m. Pacific, 10 p.m. Eastern. This is the Efros Financial Power Hour live stream. Call your friends, get some tea, grab your dog, grab your cat, let's talk finance and nerd out on all this good stuff because you know I'll be here. And with that, I appreciate you guys. Hopefully this was helpful. Thanks for watching.